All right. Good morning, my fellow profit seekers and capitalists. I am your growth stock guru, Rick Action Jackson. Welcome back. And if you're new, thanks for joining us. I use a strategy called the top quintile strategy. To make a long story short, usually about 100 of the stocks in the S&P 500 generate 80% of the gains. We want portfolios made up of those 100 stocks. And the one quality I insist upon is that they've beat Wall Street's expectations at least 2 of the last 3 quarters. Because stocks that continuously earn more than Wall Street predicts continually make more money than Wall Street expected. And that's what we want. We want to make money. So this is not advice, financial advice. This is education and entertainment. Please, before you act on any of these ideas we discussed today, go to a financial professional advisor and make sure that these stocks are appropriate for your risk tolerance and your goals, because the market's a dangerous place. And if you lose money, you've been warned. Make sure you run these ideas by a pro before you invest in them. Okay, so our first idea today that matches my top quintile criteria is Celestia, CLS. Let's go to the chart. Now, Celestia's been around for a long time. It was founded in 1971. It used to be the factory that built servers for IBM. IBM spun them off in the 90s. They were private for a while. They went public about 6 or 7 years ago. They are a contract manufacturer, which means somebody else designs something and then they hire them to put it together. These contracts are usually long-term. They're usually at least 3 years. They usually have a minimum amount of product they're going to order and a maximum amount. And if they go above the maximum or below the minimum, there are additional charges. And if you look at the 1-year chart here, if you bought it a year ago from yesterday, you got in under 200, and the stock flew up to 460. Not bad, 130% in a year. It's fallen back here below the 290-day moving average at 309. Normally when a stock breaks the 200-day average and the 90-day average, I stay away. But this company has a great balance sheet, and it's a contract manufacturer. The revenues they are forecasting are contracted. The odds of these sales not happening are extremely low, and they are under contract to see their revenues grow 75% next year. Why is that? Well, NVIDIA is about to launch a new chip. It's going to start shipping in a few weeks. It's called the RTX Spark Super Chip. This chip is so fast that if any of the connections between the data you want to run through the algorithms on this chip is not in a fiber optic connection, you're slowing the chip down. Most connections in the computer world are copper. Copper is very good at handling the signal without it being at all degraded, and it's 90% less cost than fiber optic. Fiber optic is you're transmitting the signal as a light beam through glass. Yeah, it's the size of a needle. Not easy, not very cheap. But if all your wire connections to the data are not fiber optic, you're slowing this chip down, and you're spending $50,000 a chip to get the fastest chip in the world. So the fiber optic area of technology the next couple of years, as NVIDIA rolls out these chips, are going to explode. So I like this stock a lot. I think the chart here is great. Look at all this support they have here in the 250 to 300 range. If this stock goes any lower, it's not going to go much lower. And the lower it goes, the more of it I will buy. And this contract is going to really kick in after NVIDIA launches their chip. 70% growth is anticipated next year. I have a target on this of $900 within 3 years. And it's at 309. Now, it was at 450 just 4 months ago. Stock got a little overbought. But there's nothing wrong with the fundamentals here. The only reason why this stock's down is it made a lot of people a lot of money quickly, and when the chart rolled over, the fast money left. But if you look at the 5-year chart on this, what's better than this? Stack this up against almost any other super growth company you can think of. The bottom line is we got a lot of companies in America that know how to design stuff, but they don't like making it. And normally they send it to Asia, but the president has put a lot of incentives into corporate tax policy to manufacture this stuff in the U.S. CLS has facilities in New Jersey, New York, California, Texas, and 3 other states. They're also in Switzerland, Sweden, the UK, China, and Vietnam. So they make this stuff for people all over the world. They're very good at it, and this new fiber optic chapter is really going to add some go-go juice to their growth. It's down almost 33% from its peak, and it's done nothing wrong. It's beat all the numbers for the last 8 years. Buy this stock, CLS. It's a great buy under 3.25. It's under 310 here this morning. All right, the next one we have is Mercado Libre, which means the liberal market. They are the Amazon and the PayPal and the MasterCard all in one of South America. Let's look at the chart. The 5-year chart here, you see it's mostly been a monster stock. It peaked out in July of 2025, and it dropped about 800 points. It's rebounded 20 of the points, and very importantly, see here, unlike Celestia, CLS, Mercado Libre has broken through both the 200-day, which it dipped below for just a month, and now it's back above the 90-day. That's very bullish. When a stock's below the 90 and 200-day moving average and it breaks through them again, that's very bullish. Why did this company take a dive? Well, they tripled their CapEx because they're expanding their network. Right now they deliver stuff all over South America, mostly Brazil, Peru, and Colombia, but they're in a bunch of other countries. They mostly deliver in 1 to 2 days. They're building up their delivery capabilities so you get it in 1 day or the same day. And one of the ways they're doing that is they've massively built up a drone delivery system. Yes, they are using drones. They're ahead of Amazon on this. Amazon's doing experimentally. Mercado Libre's got entire countries where all they do is deliver by drone. And they also are building up their what do you call it? AI services. They do they do internet services for small businesses, just like Amazon does. But unlike Amazon, they'll handle all those companies' credit card transactions. They have their own PayPal built into the business. Another thing that happened in July, besides the market getting a little scared at how big their CapEx budget got, was the founder of the company handed off the keys of the CEO office to a new leader, but he's staying in the chairman's office and has no plans on going anywhere. He's only a 48-year-old man. Everything this new guy's done seems great. He's beat the numbers every quarter. He's rolling out new capabilities quickly. He's opened up new divisions in Argentina and Venezuela, which were 2 countries they used to avoid. A lot of growth here. Probably about 80% of America now buys at least one thing a month online. In South America, it's still under 50%, but it's growing fast. I expect this to be a $4,000 stock in 2 years. It's currently under $2,000. This will be volatile because currency impacts it. But I think currency will mostly be positive, not negative, in South America for the next couple of years. And that's a long conversation. Why? But if you can't tolerate the volatility of international currencies, stay away from this. But typically when oil's in good shape and exports of agricultural goods are at good prices, coffee's at record highs, the South American currencies do very well, and I think they will for at least the next year. So Mercado Libre, very cheap here. Buy it under $2,000. We're hoping it's a $4,000 stock in less than 2 years. And we're going back to one we talked about before because there's new news on it. Dutch Brothers. Dutch Brothers has the second largest coffee shop chain in America. They're not at all here on the East Coast. They're mostly in the Midwest. There's 1,200 of them. They're planning to go to 2,000 in the next 2.5 years. they've been very now of the 1,200 stores out there, about 550 are owned by the company, including the land, and about another 150 of them are owned by family members of the founders, and the last 400 are franchised. So there's a lot of value here. They own a lot of real estate. I mean, most other store chains, they rent the store. They've bought the building, and one day those mortgages are going to be paid off, and the profitability will just skyrocket. But one thing that's new here is we just found out that they bought out of bankruptcy a 38 chain store of Heroes in the Southwest. I think it's called Hero Dave's or something like that. They took on too much debt and went bankrupt. The nice thing about this buyout of theirs is that all those 37 locations already had 2 drive-through windows. This coffee chain has no inside to go in and sit down and act like you're enjoying the classical music coming out over the radio. They are pure drive-through. Most of their locations have 4 drive-through windows. A couple they just recently opened up in Chicago that are doing twice the revenue per average store have 6 or 8 drive-throughs. You can order by text and pay by cell phone. They'll have the coffee there sitting for you nice and warm on a warmer right by the window. Very quick in and out. And the 2 things I really like about this business is, number one, they're busy in the afternoon because they cut their prices 50% on their drinks, and they also make milkshakes and Slurpees. And that's very popular with the younger crowd, getting a $6 milkshake for $3 after 3 o'clock, or getting a $3 Slurpee for $1.50, especially on a hot Texas day. Very popular. And they've just started to roll out food. And they only have 200 of their 1,200 locations with food. But so far, the stores that are offering food are doing very well. They're only offering 7 items, keeping it very basic. Ham and cheese croissant, pesto chicken on a roll. But they're keeping the menu simple so that it doesn't take a lot of people to make it. They make it fresh at each location, and it's doing very well. So I think this is easily a $100 stock in 3 years. This pullback from 70 to 50 is a gift. The only thing that this company has done wrong, or what Wall Street doesn't like, is their margins have dropped. But their margins have dropped because food has a lower margin than coffee. But you're looking at it the wrong way. These stores pay for the real estate, the rent, the overhead with the coffee. So that comes out of the coffee margins, which are very large. The food doesn't have to pay for any of that. It's all add-on. And the food's margin's around 50% gross, but 40% net. The coffee revenues are 36% net after they pay for all those costs. And one reason why I really like this stock, which is why we're revisiting it today, because I can't believe it hasn't gone up $5 to $10 on this news, is that coffee futures in Brazil are now lower than the current price of coffee. Currently, the current crop of coffee, and their harvest season is our winter, the current crop of coffee is looking very positive. The extra acres have been grown because there was a coffee shortage due to a bad crop last year. And if you see coffee come down 25, 30%, I doubt you're going to see these coffee chains cutting their prices very much. I think they're going to add that extra 30 cents per cup right to the profit line, and that could really give this stock some go-go juice. They're already pricing their product about a third less than a Starbucks cup of coffee, and that's before the 50% discount after 3 o'clock. So pick up Dutch Brothers before the market catches up that coffee prices are going to be a wind at their back next year. And I would say going from 1,200 to 2,000 stores should more than double the stock over the next 3 years. That's all we got today, folks. Three winners for you. I hope they work out. And if they don't, no crying to me. You've been warned. May all your trades be profitable. We'll see you down the road.